of this on not only on equity but also on commodity market. We now have CEO of AustraliaTrading.com, Peter McGuire, now joining us. Sir, thank you so much for taking your time out and joining us here on ET Now. Dollar index is again above 100. Commodities globally are rejoicing. Help us understand what kind of impact will this have on Chinese metal market and its impact on commodity prices globally?
Well, good afternoon. I mean, there are so many things to unpack here. And as we understand, I've listened to Scott Bessent, the Treasury Secretary. I'm conscious as far as the timeline and the deliverables and what is planning to be unpacked, and then the implementation. So I feel as though that one, it's going to be, I see a very strong rally as far as US dollar, that we've seen that rally up and it's nearly at 101. We've seen US futures absolutely on fire and they're very, very strong. Nasdaq's up over 3.5% in day trade. And you've had a very strong market as well with the Nifty up 3%. You've got, I feel as though it would be a good sign for quite possibly for base metals and industrial metals. And gold's been sold off, and the WTI, West Texas Intermediate, and Brent are both up the best part of 2.4%.
Clearly, equity markets, you did talk about Nifty and American futures, which continue to trade with gains. But also wanted to scratch that point further on gold, because it is already off from the recent highs of $3,500 per ounce. And now with this trade deal finally coming through, do you see more downside to the yellow metal?
Well, I think it's very volatile. We've got to look at what's happened over the last couple of weeks. We've had days where it's broken over $100 as far as day trade and a push up over on the New York session. And then other days it's down $80 and $90. So it's whipsawing. It's incredibly volatile. And I wouldn't be surprised. I mean, you've got the gold market down 2.5% today, down 87 odd dollars. I just had a look at the screen. So we could see a further push down. Where it rolls from here, I wouldn't be surprised. Maybe it's going to test that 3,100, 3,150, but it's so difficult to really forecast where we see as far as breakouts. And I really feel that probably it will trend higher over the year, but I won't be surprised if it takes another washout down as far as softness.
Okay, so volatility is here to stay, and the yellow metal could perhaps fall to $3,100 per ounce in the near future. But Peter, what's your sense when it comes to oil market? Because Brent crude fell below that $60 per barrel after OPEC Plus came with its output hike announcement, after which it did recover. But now with China being the biggest importer of Brent crude, and because of these trade deal talks, how do you expect the oil market to shape up in the near future?
Well, I think a couple of things. First off, you've got OPEC Plus, and you've got those 8 nations that rallied together, and they wanted to triple their target as far as production increases. They've taken it up to 411,000 barrels a day. That was in April. We're going to see, I think, significantly higher, that 2.2 million barrels through of gradual monthly increases up until the end of 2026. So you've got President Trump going to be in Saudi over the next couple of days, I understand, and how you're looking at as far as compliance, the likes of the UAE, Iraq, and of course Kazakhstan. So there are issues there from a compliance side, how that's going to play out, and the newly appointed Kazakhstan oil minister made reference as far as his Tengiz oil field that, with US multinational Chevron there, the country will look at being very, I think, production focused, and I'm not sure whether they're going to be overly compliant.
Okay, so that's as far as Brent crude is concerned, but also wanted your thoughts on other industrial metals. Post-COVID, China has been reeling under a lot of pressure. Real estate demand has not recovered. How do you see that shaping up, especially in light of this deal which has been signed with the US? Do you expect industrial demand to bounce back significantly? And also its impact on iron ore and steel, because iron ore has now slipped below $100 per ton. How do you expect ferrous and non-ferrous demand and prices to shape up going forward?
I want to see the timeline and how this plays out. I understand as far as iron ore, it's been spanked down under 100, as you mentioned. And you've got to look at what's going to happen from a manufacturing standpoint moving forward. where's US steel going to be, where's the demand going to come from, and naturally who's going to make these finished products. If America's going to get back into and what the timeline's going to be as far as, you know, re-engaging its manufacturing and steel production. So I think that it's a lot of unknowns at the moment, and we've got to work through that to see where we're going to see liftoff. Copper's sitting at $9,500 a metric ton. Tin's 31,000. You've got still relative softness as far as aluminium and zinc. So where we sit on the big picture of things, I want to see how it plays out, and again, whether we're going to see a gradual increase in pricing leading into the Q3.
Understood. And what's your sense when it comes to the Chinese economy? So China recently maintained its GDP growth guidance at 5% for the full year. What kind of impact will that have on the industrial metal market for the rest of the year?
Well, one good sign is you've got inflation very, very low, in actual fact in negative. So, and you've got 5% growth. So that's a good sign. Where it's looking at, we need to see domestic demand, and you need some form of bazooka to re-stimulate Chinese, the economic growth of the country. Because quite simply, if we were to see what factor this has as far as the trade talks and the tariff introduction, and whether that's going to impinge or impact the domestic market as far as, you know, growth, and what happens to the Chinese economy from an engine of, you know, that domestic demand. We all understand the overhang as far as property and what the big picture is there and how that's going to play out. So I still think that there's a lot of water to pass under the bridge yet, because 25 is going to be, again, quite a volatile end of, you know, the last two quarters.
25 is going to be volatile. That's the word coming in. I did talk about gold, and that you expect gold to touch $3,100 per ounce, and volatility will be the name of the game. But what's your stance when it comes to silver? It being an industrial metal now, perhaps demand might inch higher on account of good news that is coming in on the tariff war front, and also because silver has been an underperformer versus gold. Where do you see silver headed for the rest of the year?
I think it's going to be a lot higher than where it is at the moment. It's currently sitting $33.18. It's up 27 cents today. It's the best part of nearly, 0.82% up. I feel as though it's still relatively cheap. And when you're looking at the gold to silver ratio, there's, I think, significant upside for silver. So I'm expecting strong pricing. And again, I mean, that gold number, it may hit 31 something, or it may even hit 31, but it's going to be volatile, and I think that the second half of the year is going to show support for precious metals, and I think silver will outshine on a percentage basis what gold has performed like.
Silver is expected to outshine gold. That's the word coming in. Peter, thank you so much for taking your time out and joining us here on ET Now and helping us decode what the implication could be on the commodity market. That's all the time we have on this edition of the show. Don't go anywhere. Market Fatafat.
If you like this video, then like, share and subscribe to ET Now.